No, I didn't hear anything new. I think that we have increased scrutiny and regulation happening across the tech sector. The big platforms are not immune. We've seen other sectors be scrutinized in the past, and it's difficult to predict the outcome. It certainly widens the range of what could happen, and I think investors need to take that into account. I think you also need to look at it on a case-by-case basis. I think some companies may prove to be more regulated than others, and some outcomes, such as breaking up assets, spinning off assets, could be positive for the stocks. You've really got to look at it individually.
Brad, I mean, we could talk about regulation and what that means for the big cap tech names and the FANG names specifically, but the one name that isn't necessarily exposed to those potential headwinds is Netflix, and yet that's the one that has been falling the most and underperforming the most. I realize there's a competition component there as well, but are the fears and I guess the sell-off overblown?
Yeah, well, I think, look, there's a wall of worry on Netflix, but there's an opportunity to look long-term, and the long-term reality is that people are consuming more streaming video. That will even go up higher with 5G. It's a global market now. The long-term opportunity for streamers is billions of subscribers, not hundreds of millions of subscribers. And if you don't lose track of that, you can see that there's really an opportunity to look past this wall of worry. In the short term, there's more products coming out. There's more competition. Netflix has some things they can do, such as the content slate they have coming over the next 6 to 12 months to offset that. But consumers have budget to spend on multiple streaming apps, and I think that's the reality that we're in.
Yeah, Brad, I wonder what you think is going on here with some stocks that had been hot, including some recent IPOs. I mean, Lyft is off 12% for the week. It hadn't been performing that well to begin with. Roku's been public for quite a while, but have been hot. It's off 19% for the week. Look at Shopify, Stitch Fix, a lot of stocks pretty close to, if it were a broader index, what would be called correction territory. Is there a sort of revaluing around growth going on? And what's the impact then on investing in startups, you think, of Silicon Valley?
Well, I think there's been a lot of money that's been sloshing around Silicon Valley and private markets and private market valuations for several years now. I think there's a little bit of a clash now as some of these assets have come public. I think there's been a little bit of an underestimating of the rigor and sort of frankly the intelligence of public market investors that's taken place by private market investors, and now we're seeing that clash come together. We're seeing a resetting of expectations. But I'd look at it on a case-by-case basis. There's a lot of excellent companies that have come public. There's a lot of excellent companies that are coming public. But the scrutiny and the rigor and the assessment of what the valuations of those companies are going to be will be what it always has been for public investors. And I think that reality needs to be faced and is being faced. And we're seeing that in some of the recent headlines that we've seen, such as with WeWork and some of the other valuations that are being adjusted.
Do you think WeWork is a tipping point in terms of that assessment in the private markets? I just wonder how much is actually going to change, given the fact that we have now a situation where it's lower rates for longer and this ongoing quest for yield.
Yeah, so I don't know that I would call it a tipping point. I think each example should be looked at independently. We are still in this low rate environment. There's still a lot of money sloshing around Silicon Valley and in the tech startup space, and that probably won't stop. I don't see any sort of reason for a run on the bank or a rush to the exits. But the reality is that ultimately, as these companies get bigger, they do need access to the public markets, and you need to mesh the two views of public investors with private investors, and recently those have been out of sync. It's sort of been going on for a couple of years. I think there'll be a healthy reconciliation of that, and we'll get back to seeing a lot of great companies come public, which public market investors are eager and excited about.
Well, we've talked for so long, Brad, about companies staying private for longer, elongating the window before they come public. Now that the market seems to be insisting more on a path to profitability, does that window get even longer than it was?
Well, I don't know that the market's insisting more on a path to profitability, but I think we've always insisted on the fact that path exists, and so you do need to have some proven economics. If we can see that path, if enough data is provided by the companies as they come public, if the oversight of the companies and the governance are in good shape, then I think we're certainly willing still to give the same leadway we always have as long-term growth investors. But if that governance isn't there, if the data is not there, if we can't do the analysis, that's going to make it really hard. But I certainly think there is still room for companies who are not profitable to enter the public markets and eventually make their way to profitability by partnering with public investors and giving the data that people need to make their assessments of the valuations of those businesses.